Mergers and acquisitions are pinnacle moments, promising business growth and transformation. But the biggest threat isn't the negotiation. It's a tax bomb hiding in the balance sheet, set to detonate post-close. These aren't exotic problems. They often stem from common oversights such as misunderstandings of state and local tax obligations. The danger extends deep into your operations, even into how you classify your workforce, creating massive downstream risk. We'll show you the tax strategies you must employ, moving from identifying red flags to structuring deals for maximum financial benefit. So where does strategic tax planning begin? It starts with one foundational choice that dictates everything that follows. Are you buying the company's assets or its stock? Your answer profoundly changes the tax outcome for both parties. Buyers almost always prefer an asset deal. This allows them to step up the tax basis of assets to fair market value. Sellers, especially C-Corp, push for a stock deal to avoid the dreaded double taxation, once at the corporate level, then again for shareholders. This fundamental conflict is why tax due diligence is not a checklist. It's a strategic investigation to identify opportunities and uncover risks. What's a major red flag? Consistently late or unfiled tax returns. It signals deep operational or financial distress. Increasing an asset's basis to its current market value creates a higher depreciation start point. This translates directly into larger future tax deductions. Bonus depreciation can allow a buyer to expense 100% of the cost of certain assets in the first year. This creates an immediate tax shield, making an asset deal very attractive. But what happens if the seller absolutely refuses an asset deal? Are all these powerful tax benefits simply lost? Even inside an asset deal, how you allocate the purchase price is critical. Errors in this allocation can distort depreciation schedules and invite intense IRS scrutiny. We've covered the core structure. Now let's shine a light on the specific landmines you'll find during due diligence. Example 1. State and local taxes. A company with remote employees in a new state may have created nexus, an obligation to pay taxes without realizing it. Example 2. Worker misclassification. If the target company misclassified employees as contractors, the buyer inherits a significant liability for unpaid payroll taxes. Example 3. Employee benefits. Inheriting stock option plans or deferred compensation can create unforeseen tax burdens for the acquiring company. These aren't just details, they are potential deal breakers. So how do sophisticated players handle even greater challenges? Consider net operating losses, or NOLs. They seem like a valuable asset, but their use is heavily restricted by rules such as IRC Section 382, which limit income. On top of internal issues, you face external ambiguity. Potential changes in corporate or capital gains tax rates directly impact deal valuation and timing. Recall our question? What if the buyer wants asset deal benefits, but the seller will only do a stock sale? This is where advanced tax strategy shines. Clever structures exist to solve this. For S-Corp, an F reorganization can legally be a stock sale, but provide the tax treatment of an asset sale. A Section 338H10 election does something similar, giving the buyer the desired step-up in basis. These are sophisticated tools for aligning interests. Handling all this seems challenging, but what if you could shape the tax landscape before the deal even begins? This brings us to the most powerful strategy: pre-transaction tax restructuring. Remember the conflict between buyers wanting asset deals and sellers? Pre-deal restructuring allows a seller to organize their company to soften the tax impact of an asset sale. This is why due diligence can't be a passive checklist. The red flags you find, like worker misclassification or SALT issues, become the roadmap for the pre-transaction cleanup. This transforms tax planning from a defensive shield against liability into an offensive tool for creating value and bridging gaps between buyer and seller. Finally, know that the work isn't over when the deal is signed. Effective post-merger tax integration is required to realize planned benefits and avoid surprises later. From identifying hidden liabilities to picking the foundational deal structure and deploying advanced strategies, proactive tax planning is not optional. It is the main discipline that contains catastrophic risk and creates the maximum financial outcome in any merger or acquisition. The key takeaway is simple. Bring in expert tax counsel at the very beginning of the M&A process, ideally before a letter of intent is drafted. Don't let tax be an afterthought that destroys your deal. Make it the strategic element that ensures its success.